All right, a very good evening to you all. So our lesson today is going to be about the analysis of financial statements. Remember your financial statements, which are your income statement, your statement of financial position, your cash flow statement. They are very difficult to understand from a layman's point of view. You need to be an expert in interpreting figures to be able to understand the information that is being relayed by these financial statements. So as financial planners and financial controllers, you need to know ratio analysis. These are like summaries of all the figures that you find in financial statements that are put in a certain language, which is called the ratio language. So these ratios, they tend to summarize the broader financial statements, and you can use them to compare from year to year. As you can see here, you've got a financial statement, extracts for financial statements of Sanchia Limited on 31 December 2019-2020. If we compare figures like this, it can be very difficult. But if you compare them as ratios, you would know what part of the business are you comparing. Are you comparing the profitability? Are you comparing the activity? Are you comparing the ability to pay debt? Are you comparing the liquidity? Are you comparing the solvents? Something like that. So you need to be, you need to know what you are comparing so that you will be able to explain these ratios. So I'll urge you wherever you are, may you please, apart from this screen, may you please have your study guide with you. I want you to have your study guide with you. Whether a physical study guide or you might have it here on the screen. All right, just have your study guide with you because I'll be asking questions there. All right, so let's start with this question here. It says here, use the information below to answer the following questions. Calculate the following ratios for 2020 only. Express these answers to 2 decimal places. So when you are calculating ratios, you need to be using financial statements like the financial statements that are given down here. You use these financial statements, then you calculate your ratios. And for you guys, it's very easy because it's an online assessment. Being an online assessment, you have got access to your study guide, and you don't need to memorize the formula. You don't need to memorize the formula. That is the good thing about this. You can refer to your study guide, you get the formula, but you have to know the figures to pick when you are calculating the ratios. So let's start with the first one. This is where I said I want you to be opening your study guide. So the first question says, calculate the following ratios for 2020 only. Express the answers to 2 decimal places. 3.1.1. Let me write it here. 3.1.1 says calculate the gross margin. Calculate the gross margin. So when you say the gross margin, how do you calculate the gross margin? From your study guide. From your study guide, you go to ratios. Someone to tell me?
I'm trying to find the page number, Jasper. Ratios is not in the thing, in the table of content.
Check analysis of financial statement then. Let me see.
Financial analysis, that one.
Yes.
Ratio analysis, it's fine, 6.2.
You got it.
Gross profit over sales.
Yeah.
Times 100 over 1.
Over sales times 100. 100
over 1.
Yeah, it's still fine just to say 100. So wherever you see the term margin, sorry. So let me do this. I want to remove equals there and say gross profit over sales times 100. So wherever you see the term margin, Wherever you see margin on the ratios, it means sales. Wherever you see a ratio that says margin, profit margin, it means the denominator is sales. So this one is gross margin. It therefore means it's gross profit over sales. Then if it's profit margin, it therefore means profit, net profit after tax over sales times 100 over 1. Okay, so let's come to this figure, to this one, and then look for gross profit. What is the gross profit here? The gross profit you are not given, but you are given. Can you see that you are given cost of sales? That means you have to know that your gross profit is a derivation of your sales minus cost of sales. That means you have to come here and subtract your sales is equals to 3,850,000. Then your cost of sales is 2,350,000. So this is what they are testing you there. Do you know how to get gross profit from the figures that you are given?
Yeah.
Yes, you can speak.
So it's 1.5 then. It's sales less cost of sales equals gross profit. Am I wrong?
Yeah, this one minus that. Then
Yeah.
you get 1.5 million.
1.5. Yeah.
So it's equals let me remove that equals 1.5 million over, what is your sales? Is 3,850,000 times 100. So you can calculate that. 1.5 million. Let's do it like this. This is easy. This is an easy topic because you get the figures from there. But it only becomes tricky when they don't give you the gross profit that you want to use. So you have to know how to calculate it. But still, you can go to your financial statements. You can see how they are ordered. 1.5 million.
Is the answer supposed to be in percentage?
Yeah, it's supposed to be a percentage because you multiply by 100.
I get 3. Yeah, dumb question. I get 3.89.
Yeah, 38.96. Because the question says to 2 decimal places.
Oh, okay. Must pay attention.
The question says to 2 decimal places. So it's actually 38.96%. You get that?
Yeah.
All right. Let's go to the next question. Okay. The next question is 3.1.2, which is current ratio. Which is current ratio there. Current ratio. All right. Those that have got formulas, what is the formula for current ratio? What is the formula for current ratio?
Current assets divided by current liabilities.
Divided by current liabilities. That's right. Current assets divided by current liabilities. That means your job is to identify the assets and the liabilities. So you come here, you have to know your current assets. Your current assets, you've got inventory. So let me write it here. You've got inventory, which is inventory is a current asset. Is a current asset, which is 1 million. 1, 2, 3, 1, 2, 3. We've got inventories. What is another current asset that we have there? Trade and other receivable, accounts receivable only 400,000. Okay, that is another current asset. Then cash and cash equivalent, which is 5,000. That is the current asset. Do we still have another current asset? Let me see. Overdraft is a liability. Cash and cash equivalent is a current asset. Trade and other receivables, current assets. Ordinary share, no. So in inventories, no. So we come here, we add I'm looking for the plus. Where is this? I'm looking for a certain sign. All right. It's not here. Let me say equals this plus that plus that, which gives you 1.405 million. Then your current liabilities, I'm going to write them here. I can see in my current liabilities, we have got accounts payable, which is 240,000. We put it there. Then we go to bank overdraft. Let me see. Yes, bank overdraft. We've got 10,000. So the total equals this plus that. So according to this formula, you say 1,405,000 divided by 250,000. Divided by 250,000. What do you get? What do you get?
56.
Remember,
Am I wrong?
our answers are two decimal places. 1,405, 123 divided by 250,000. 5.62. So it's actually one is to 5 point, no. It's actually 5.62 is to 1. So you can leave it like this or just as 5.62. 5.62 is to 1 is the same as saying 5.62 divided by 1, which is 5.62. Why do we say is to 1? Because the ratio, because it's a ratio, it's current assets as to current liabilities. So you can leave it like this, or you can just put it as 5.62. Here is the same. It gives you the same answer.
Will it always be the decimal is to 1? Or is it ever possible for it to be the decimal is to 2?
What you do here, because you are saying current assets as to current liabilities. So the moment you divide current assets divided by current liabilities, you are getting the different, the first answer. And the moment you are dividing with the current liabilities, you are making current liabilities 1. Because you say 250,000 into 250,000 into 1. 250,000 into 1,405, that's when you get 5.62. So always it will be S to 1.
Okay. Thank you.
Right. So it's 3.1.3, which is the data collection period. Which is, so this is the time that you spend before collecting your debts. Debtors collection
Period.
Okay. How do you
Accounts.
accounts?
Okay, sorry. Accounts receivable. Accounts
Yes.
receivable divided by credit sales multiplied by 365. But I think it's accounts receivable multiplied by 365 divided by credit sales.
All right. Accounts receivable over credit sales.
I don't think it's, I think, Jasper, the way it's written, I think it's accounts receivable multiplied 365 divided by credit sales.
Yes, it's still fine. It gives you the same answer. Because this 365 is multiplying everything. So it multiplies the numerator actually. Okay. This one, it multiplies the numerator. Okay. So which is 3 accounts receivable times 365 over credit sales. Right. So you come here. What is your accounts receivable? We have it already. Accounts receivable, it's given. It's 400,000. Do you see that? Here is accounts receivable. Yeah. Accounts receivable. Then your credit sales. we have got sales here as 3,850,000, but we are not sure whether this is credit sales or cash sales. So let's see at some notes. It says here 70% of the sales are on credit.
On credit.
So you come here and say 0.7. 0.7 times your sales, which is this one. Okay, sorry. Let me delete and say equals 0.7 times the sales, so that I can find credit sales. There it is. Then you now say 400,000 times 365. Everything should be in brackets. This on top should be in brackets. And then you divide by credit sales, which is 2,695,000, like that. Okay, so let's calculate. Let's calculate 400,000 times 365. Oh, okay, it's fine. 2,695,123 times 365. It gives you 54.17. That's
Yes, that's what I got also.
okay. Gives you 54.17, and these are days, because we are looking at the data collection period. So these are days.
But in one of the other lectures, you said to us, there's no point something days. It's either a day or it's not a day.
Yes, you are very right. We were looking at the, I think it was the economic order quantity and what was it? Oh, okay. It was, I can't remember what it is. But the reason why we write the data collection period as with commas like that is there can be a data collection period that is 54.16. So when they ask you to compare, you need to write it as it is when it comes to data collection period. But when you're talking about I think we were talking about inventory, we're talking about project evaluation, and then we're talking about payback period. So with the payback period, we cannot talk of a comma of a day, but with the data collection period, we have to put it because you will be comparing maybe years. One of them can be 54.18, one of them can be 54 point. So in comparison, it makes a difference.
Okay.
Yes. Right, that is the data collection period. Let's go to the other one, which is the creditor payment period. That is 3. I hope everyone is following because I can only hear one voice here. Creditors payment period. Creditors payment period is yeah, I want you see on this one, I want to change this one and say multiply by 365 there so that people don't take it. I want to change there. This one, it will be accounts
Payable. Accounts payable divided by credit purchases.
Let me say times 365.
Yeah. And
Time.
divided by credit,
Yes.
credit purchases.
Divided by credit purchases. Okay, that's fine. So do we have accounts payable? Yes, we've got accounts payable, which is 240. I think you can see 240,000. Then, do we have credit purchases? Okay, we don't know. We don't know credit purchases, but I want you to look, there's a statement here. 60% of the purchases of inventory are on credit. So what we need to do here, there is something that we did in our short essay that we need to do here, because we don't have the purchases figure. Do you see here? We don't have the purchases figure. But we know something. Let me show you. We know something. You know this formula. You know that in a firm, you have got opening inventory. Usually, if you are in a factory, you have got opening inventory. Then you put your purchases. You put your purchases. So what's your opening inventory here? You come to 2019, because the closing inventory in 2019, which is 630. Do you see the 630?
Yes.
So 630 is your opening inventory. And then purchases, we don't know what you purchased. But what you did at the end of the day, you had a closing inventory. Oh, so this figure here that you get, this figure that you get is goods available for sale. Goods available for sale. Right. Then, how many did you sell? How many did you
3.850, the sales.
All right. The sales is
3.850
Okay, but before we go there, I'm actually complicating things. You can do this. If you subtract from this figure, if you say less closing inventory, which is this figure, which is now closing in 2020, which is 1 million. If you say less closing inventory, you should get a figure that is called cost of sales. Yes.
If we deduct the opening and the closing, then we get cost of sales.
Yes, if you say opening inventory plus your purchases, and then you get goods available for sale, and then you subtract your closing inventory, you find your cost of sales. And your cost of sales you have, which is 2,350, 1, 2, 3. So you work backwards. So which figure was here? Which you, when you subtracted 1 million, you got this, which is, therefore you say this one plus. Therefore, your goods available for sale were 3,350,000. Then already you had 630. So you said this one minus
630.
minus 630. What's happening there?
That was an underscore. It wasn't a minus that you used.
Oh, it wasn't a minus. Equals this one minus this. You get 2,720,000, which is your purchases. Nice. So this 2 million, you need to know how to get your cost of sales. That's where the testing is, to get your purchases. Because you will not find purchases here. You have to use this formula. Let me take it. Let me cut it.
Can you label it, please, Jasper?
Yes, let me cut it. Where am I now? And paste it here on sheet number 1. Okay. Let me put it there. So this is actually the calculation of purchases. I think you can see it's clear now.
Mm.
So this is the purchases figure that we want, you see? And you have to work backwards. So according to this, it says here, 60% of purchases of inventory are on credit. So the ones that are on credit are 60%. So we say is equals 0.6 times this. You get 1632. So your credit, now you've got your credit purchases. It's now easy. So your accounts receivable, which is equal to 240,000 times 365 divided by your credit purchases, which is 1632,123. Okay, so if you do it, let's do our calculation here. This is where the test was to calculate your purchases. So you say 40,000 multiplied by 365 divided by 1,632,000. You get
53.67.
53.68.
Okay, 68
And
because if
also,
you round it
you
off, yeah.
see why we are rounding, because we have been told that we should round to 2 decimal places.
Okay.
Yeah, so it's days, because it's creditors payment period. So we spend 53. So we take 54 days to collect money from our debtors, and we take 53 days to pay up our debtors. So this is not right, because we should delay to pay and quick to collect. So this is not a good scenario. We should be quick to collect and delay to pay. So this one was supposed to be like 20 days. This one, 53. If they say comment, let's look at the return on equity. 3.1.5 return on equity.
Mm.
All right. The return on equity, what is the formula?
Profit after tax divided by equity multiplied by 100/1.
Yes, you're right. Profit after
Tax divided by equity.
divided by equity. Let's hope the way I'm writing won't confuse. Times 100. So it is
100/1.
Yeah, so it is this that should be done first before you multiply by 100. Okay. So the profit after tax, do we have the profit after tax here? We have got operating profit. Do we have profit after tax? Let me see. You see, we don't have profit after tax. That means we need to calculate it. You see, they have given us the 20% tax.
Mm.
So you come here to operating profit. The company tax is there, 179. It says company tax, so we need the pre-tax profit. Do we have interest here? Let me see. Non-current liabilities. Yes, then say all assets, equity and liabilities are included in the extract. Okay. Common tax. Okay. So let's look at operating tax, operating profit. So we've got the operating profit there. So let's look at 28%. According to them, they said common tax calculate 28% of the pre-tax. So we come here and say equals to calculate the tax 0.28 times the pre-tax, which is 700,000. Yeah, it's not right. Times 700 then you get 196. But here we have got 179, which is not it. The figure that we should have gotten was 176. Okay, let me see if there's another thing that I left. Is there any figure on interest here? There's no figure on interest, ne? We've got common tax. So we use 196, because 196, we charge 196 on the operating profit. Okay, because we do not have tax here. So what is your operating profit? It's 700,000. Okay, so the profit after tax equals this minus that, which is 504. So the profit after tax, which is 504,000 divided by equity. Equity is equal to ordinary share plus retained earnings. So we can say ordinary shares plus retained income. So we can still calculate them. 504,000 divided by, what is your ordinary share capital? It's 1,400,000 plus. What is your retained income? Do you have retained income? Yes, we have got it. 250,000. Okay, so we've got 250,000. Let's add the two. 1400,123 plus
It's 650.
it's 1,650,000. So it's 504,000 divided by 1,650. Then we multiply by 100. Return on equity 504,123 divided by 1,650,123 times 100. You get 30.54.
54. Yeah.
Which is equal to 30 points.
But now this one, we don't round off because I got 30.545. So how do we know when to round off and when not to? Or is there a margin that they give you?
Because it says to two decimal places. So you look at two numbers after the comma, which is 54.
Oh, I see now. Okay,
So
I see now. You're
yes, you round to 255. Okay, so return on equity is done. Let's look at the next one. The next one is debt to assets. Yes, 3.1.6. What is the formula for debt to equity?
total debt divided by total assets.
All right, so we come here and say total debt divided by total
Assets.
That means we are taking all the long-term debt and the long-term assets. So
Times
we come
100.
here. Yes, I'm
Times
going
100.
to, or times 100.
Yeah.
Let me say times 100. These formulas, we get them in our study guides.
It's 118. It's from page 112.
Page
If
112. All right.
Yeah.
So let's look here. Let's list our assets. Sales is not an asset. Cost of sales is not an asset. Operating profit not an asset. Kanban tax is not an asset. But okay, let me see. No, that's fine. Retained income. So let's take non-current assets. Do you see the non-current assets? It's 895,123 is an asset. Then inventories is an asset, which is 1 million, 1, 2, 3, 1, 2, 3. Then non-current liabilities, we have non-current liabilities is 400,000. Then current liabilities we have, which is 240. Then still, I think we still have got current liabilities. We have got account receivable, which is 400,000, is an asset. Then we have got cash and cash equivalents, is an asset, which is 5,000. Then we have bank overdraft, which is 10,000, the current liability. Okay. If we add there, say equals this plus that plus this plus that. Okay. So for extent, so these we've added already. So these are the figures for current assets to current debt. So which is equals to debt. It's actually debt to asset. Ne? So it's this over this, which is equal to 650,000 divided by 2300 times 100. What do you get?
35.37. No, I'm lying. 35.38. What do you get?
Okay, let me do now 650,000 divided by 2300,123. It's 28.26.
Yeah, I divided it wrong.
Okay, 28.26%. Remember, this is the percent, or this is the debt to asset ratio. Okay. Okay, this one should be 6 here. Right, let's go to the next one. The next one is inventory turnover. Is 3.1.7. Talks about inventory turnover. So inventory turnover is how many times you sell your inventory. So the moment you, okay, how to calculate it?
No, so okay, sorry, I didn't mean to interrupt. It's cost of sales divided by average inventory.
Cost of sales divided by average
inventory.
So
But you were saying, you said the moment
you see the word turnover, it's inventory. It's the number of times, like turnover. How many times do you sell, how many times do you sell your inventory? So cost of sales you have, which is 3.
2,350.
Okay. Divided by your average inventory. You add the closing and the opening inventory and you divide by 2. So it's 1 million plus the other inventory 630. Then the 2, after adding, you divide by 2 to get the average. So what do you get on average inventory? It's 1,630,000 divided by 2. You get 815. So actually it's 2,350,123. Okay, divided by 815. So it gives you a number as in times. So equals 2,350,123 divided by 815. 123. Okay. So it gives you 2.88 times. That means, what this means is you are selling your inventory about 3 times. You are turning your inventory. You are going to buy, if you are buying 1,000 units, 1,000 units, they are finished. You go and buy other 1,000 units, they are finished. Another 1,000 units.
So is that per annum or per month, Jasper, or per semester or term or what?
Now it's per annum, because
Per
all
annum.
these figures are per year.
Okay. Oh, okay.
Yes. Then would the shareholders be satisfied with their return on investment? Yes, the shareholders will be happy with their return on investment. This is 3.2. So the shareholders are the ones that get the return on equity. Our return on equity is 30.55. So we can say the shareholders will be happy. The shareholders will be happy with the return on investment, because return on equity, which is ROI, is 30.55%, which is far above the normal interest rate. The normal interest rates that we know in South Africa, they are not even close to 30%. So that return is good, because they are getting far more than the prevailing interest rates anywhere in South Africa. So that is good. Right, 3.3. They say, is the current ratio for 2020 satisfactory? Yeah, the current ratio is 5.62. Right. So we can say, let me say here if they have. Right. The current ratio
Is current assets divided by current liabilities.
Yeah, the current ratio is safe, but not satisfactory. Not satisfactory because there is too much cash. There's too much cash that is held up in assets. Look, we are saying here, what we need to pay is 1 unit. If you check here on this calculation, what we need to pay is 1 unit, but what we have is 5.62. That means a lot of your money is held up in your inventory. It's held up in your debtors, in your accounts receivable. So this is not a good thing. If you want to use cash, you cannot have access to your cash because it is held up in your inventory. So it is not satisfactory because most of your cash is held up in your inventory. Then it says a comment on the collection of debts from credit sales. So the collection of debts, I think I commented on this one when I told you that the collection of debts is not good. Okay? The collection of debts is not successful. Is not successful because we are paying, because if you check here, we have got a figure also that we're given. The credit terms 30 days. Do you see it down here? Yeah. Because we are beyond the credit terms given to clients.
So which means we collect after the 30 days and not to the 30 days.
Because it's 50. Okay. That means we are collecting some 24 days late. This is 24 days late. This is not good for a business. Collecting 24 days late. So this collection period is not good. We are collecting our dates late. You can also compare the debtors collection period to the creditors payment period. The creditors payment period is 53 days. The debtors collection period is 54 days. It means we are collecting late and paying fast.
Jasper, what is a good example of a healthy current ratio then? If that 5:1, obviously it does
Or
make sense.
a standard one should be 2:1.
Yes. Yes. 2.
Yeah, 2:1. If you
Okay.
can cover your liabilities, your current liabilities, that is healthy.
Okay.
Yes.
Thanks.
Okay, guys. So this is the topic for financial statements. We can show evaluation of financial statements. So this is how it's done. So I've sent a certain question in the group. I've sent this one that we have done. I've sent another one that we have not done. So please practice those questions. Check the formulas from the study guide and try to work on your own. If you encounter problems, please come back to me. And please check your KCQs if they are done. And the bookings for online assessments is already open. All right, is there any other question?
Nothing from my side.
All right. Any question, guys?
Nothing from my side, sir.
Okay, sure. So I'm going to